Hello everyone and welcome back to Explain the Charts. It's November 7th, 2025, and today we are doing an in-depth analysis of the S&P 500 ETF, SPY, after a very turbulent day in the markets yesterday. The entire market, especially the tech sector, took a significant dive, and there's a lot of concerning news behind the move that we need to unpack. Yesterday's session saw the S&P 500 lose over 1%, with the tech-heavy Nasdaq dropping nearly 2%, as jitters around the economy and high-flying tech valuations finally seemed to boil over. This wasn't just a broad market sell-off. It was led by the generals of this bull run, with giants like Nvidia falling as much as 3%. This action comes as major headlines are pointing to renewed concerns over whether the Magnificent Seven have flown too close to the sun. CEOs at both Morgan Stanley and Goldman Sachs have recently warned of potential 10 to 15% market corrections, and some fund managers are now calling the market dangerously overvalued, comparing the AI hype to past market bubbles. This bearish sentiment was heavily fueled by some very weak labor market data. A report from Challenger, Gray and Christmas showed that October had the worst layoff announcements since 2003, a stunning statistic that points towards a rapidly cooling labor market. This data sent traders fleeing from riskier assets like stocks and into the relative safety of bonds, which is why we saw Treasury yields fall sharply yesterday. On top of this, we have major uncertainty stemming from Washington that is weighing on sentiment. The Supreme Court is currently hearing arguments over the legality of Trump-era tariffs, and a rollback could have massive, unpredictable implications for trade and corporate earnings. Furthermore, the U.S. government shutdown has now entered its 37th day, the longest in history, which is clouding economic data and hurting industries like the airlines. Even the commodity markets are flashing warning signs, with Saudi Arabia cutting oil prices to Asia, signaling a bearish outlook on a growing global oil glut. So with that macro backdrop, let's turn to the daily chart to see how this has been reflected in the price action. As you can see, SPY has been in a powerful uptrend for the better part of a year, setting all-time highs just last week in late October, up near the $689 mark. This has been a period of steady accumulation, with most pullbacks being bought up relatively quickly. However, the price action in the last several sessions has shown significant weakness, culminating in yesterday's big red candle. On November 6th, we saw a drop of nearly 1% on heavy volume, which is crucial because it confirms there was real institutional conviction behind the selling. This move decisively breaks the market structure of higher lows that we've seen recently and puts the immediate uptrend in serious jeopardy. The prior all-time highs around 689 now act as a major resistance zone that will be very difficult to overcome in the short term. To the downside, the first area of significant support we need to watch is the low from the sharp drop on October 10th, which sits right around $653. Below that, we'd have to look at the consolidation area from early September around the $635 to $640 range. Let's zoom in on the price action since the beginning of October to get a clearer picture of this recent topping action. You can see the powerful rally that took us to new highs, but notice the sharp, one-day drop on October 10th. While the market did quickly buy that dip, it's an important reference point, as it shows where major buyers were willing to step in previously. The rally then continued, but it failed to make a significantly higher high before rolling over this week, which is a classic sign of trend exhaustion. Yesterday's candle is the most bearish we've seen since that October 10th drop, and it closed below the lows of the past several sessions, engulfing the prior day's price action. This price action suggests a potential short-term top, possibly a double top pattern, has been formed. The key battleground right now is the area between yesterday's close of 670 and the low of 668. A failure to hold this zone would not only confirm the breakdown but would also open the door for a much deeper correction toward that 653 support level. Switching over to the 1-hour chart, we can see the anatomy of yesterday's sell-off in more detail. It was a relentless, session-long decline, marked by a series of lower highs and lower lows with almost no meaningful bounces along the way. This kind of trend day indicates that sellers were in complete control from the open to the close, and buyers were nowhere to be found. The market sliced through several minor intraday support levels without hesitation, turning them into new resistance on any small bounce attempts. The low of the day was hit late in the session at 668.72. That 668.72 level is now the most critical short-term support level to watch. It's the line in the sand for the bulls. Any attempt at a rally today will likely face immediate resistance near yesterday's opening price around 676.50. A failure to reclaim that level would suggest any bounce is just a temporary relief rally in a new downtrend. The fact that we closed near the lows of the day without a strong bounce is a particularly bearish sign heading into today's session. Drilling down to the 15-minute chart gives us an even finer view of the selling pressure and order flow. Notice the spikes in volume that accompanied the sharpest drops throughout the day yesterday. This is not retail selling, this is institutional distribution. In the final hours of trading, we saw a slight consolidation right above the 669 level, forming what could be interpreted as a small bear flag before the final push down into the close. The small bounce off the 668.72 low to close just above 670 could be some late-day short covering, but it was not a powerful reversal with convincing volume. We are seeing some minor stabilization in the pre-market, but the bearish sentiment from yesterday's heavy selling is still very much the dominant force. Traders will be watching the opening price action very closely for clues. A gap down would be very bearish, while a gap up that gets sold off would also confirm weakness. So, let's go back to the daily chart and put it all together to outline the potential scenarios from here. In the bullish case, the market aggressively interprets the bad economic data as a reason for the Federal Reserve to cut interest rates in December. The CME FedWatch tool is already pricing in a 67% chance of a cut, and a dovish statement from a Fed official could be the catalyst for a reversal. If buyers step in with force and defend the 668 to 670 support zone, creating a bullish reversal candle today, this could be written off as a necessary and healthy pullback. A strong reclaim of the 677 level would be the first sign that bulls are back in control, potentially trapping shorts. However, given the weight of the negative news and the weak technical picture, I would assign this scenario a lower probability, perhaps around 35%. The bearish case, which seems more probable right now, is that the valuation and economic concerns trigger a larger, overdue correction. If we break below yesterday's low of 668.72 with conviction and high volume, the next logical target becomes the October 10th low around 653. This would represent a significant decline from the recent highs and confirm a change in the market's character. A continued flight to safety in bonds, a rising volatility index above the 20 level, and more negative macro data would reinforce this bearish view. I'd place the likelihood of this scenario higher, at around 65%. So, to recap the key levels to watch, major resistance is at 677, and then the all-time highs around 689. Critical immediate support is at yesterday's low of 668.72, followed by the more significant support at 653. Keep a close eye on any new headlines regarding the tariff situation, any unscheduled statements from Fed officials, and of course the upcoming official jobs report data. This is a pivotal moment for the market, so manage your risk accordingly. That's all for today's analysis. Please remember, this video is for informational and educational purposes only and should not be considered financial advice. The markets are complex and unpredictable, and you should always conduct your own thorough research and consult with a certified financial professional before making any investment decisions. Thank you for watching Explain the Charts, and we'll see you in the next one.